And now let's turn our attention to the stock markets, where there may have been some profit booking on Friday, but by and large it's been a blockbuster rally over the last few weeks for Indian stock markets, which has catapulted both the Nifty and the Sensex to lifetime highs again and again this week alone. Now, this surge has been driven by a number of factors, including rising corporate earnings, better than expected GDP growth numbers, the easing of inflationary pressures, and the possibility that we could be approaching the end of the cycle of rising interest rates. And also, finally, and perhaps most importantly, the return of foreign investor flows in a massive way. Since April alone, as a result of all of this, the stock market has rallied more than 8%. Q4 earnings have been strong and have been pointing towards continued demand traction. However, it's been the small and mid-cap indices that have been outperforming the large caps in the last couple of days. Another factor, of course, that has been contributing to the rally is the fact that the US dollar has been weakening against other currencies, which has made Indian stocks more attractive to foreign investors. Domestic flows are also continuing and are looking quite solid. Now, amid all this optimism and the scaling of new peaks by the markets, there are concerns and reasons enough to remain somewhat cautious, whether it's the possible of a resurgence of inflation which could be coming, a slowdown in growth, or even geopolitical risk. What's going to happen with Ukraine and other such issues? What's going to happen to oil? So, is this the peak, or is there a lot more to come? There are many who may have missed out on this rally and are now feeling a strong sense of FOMO. What is the advice for them? Joining us to discuss this and a lot more, two of the leading market experts right now, market veteran Samir Arora and Feroze Azeez, who's the Deputy CEO of Anand Rathi Wealth Management, both of them joining us on this program. Samir, let me start with you first, because you've been, monitoring trends and driving the markets for, 29, 30 years right now. So, Samir, tell us, sometimes when you're hitting these all-time peaks in the market, there is a sense of nervousness. What has happened? Has it risen too fast? Is it all going to go sour? Is that the sort of nervousness that you would be feeling right now? Or do you think, hey, this is just a start? There's a long, sustained bull market ahead, so don't worry about it right now. What would you be feeling?
Well, sometimes they may make you nervous, but this time definitely not. Because if you see what is the return for this calendar year, it's like less than 7-8% in 6 months. If you see what was the return last year in rupee terms, it was like 4-5%. So this high has come with, because you basically crossed a number of about a year and a half ago. And these returns for the past 2 years are way below our normal annualized returns of our market, which would be in the mid-teen range of 13-15% per annum. You look at any longer-term period. So I would say it's better to call it just one small step and more of what may happen in future in terms of FII interest plus domestic money and so on and so forth.
Right, Samir, you make a good point. You're saying that what is happening right now is not irrational exuberance in any sense, because forget about the last 6-7 months. Even if you take a look at the last 4 or 5 years, it's not as though the markets have been rising in a crazy manner even for 4 or 5 years. Is that the point you're making? This is not irrational exuberance right now.
So past 5-year returns are in the range of 13.5-14%, depending on which index you use. And these are the longer term returns from our market going back 10 years, 20 years, 25 years. Broadly, they all end up in mid-teen numbers. And so the past 5 years are also in that range. And last 2 years have been below this. So therefore, today or yesterday crossing all-time high is, actually in theory, every day should be all-time high if the markets were smooth, like a fixed deposit where every day interest is accruing and therefore it is higher than day before. In markets, because these things don't happen evenly, you call them that, oh, it's a high, but it should be in theory every day, and it's not out of line with its history.
So you're saying if you're looking at historic returns, this is not irrational exuberance, but what about valuations? When you take a look at valuations of the Indian market, and especially if you compare them with the rest of the emerging markets, India is trading at a significant premium to the others.
India historically has traded in the 40% type range. And today you may say it's 45, 47% range. But one reason for that is not that India has gone up too much, because as we just said, last 2 years it has gone up cumulatively maybe 10% or 12%, is because the Chinese market has got crushed a lot. And therefore our premium to China looks high. I mean, China is a big part, 1/3 of the emerging market. And therefore, if Chinese market falls, it looks as if the rest of the world is doing something wild, whereas it has more to do with China doing badly. If we say that last 2 years our market is up 4% and now maybe 7-8% this year in half a year. So in 18 months we are up 10%, which is definitely 12%, which is definitely below our earnings growth over this period. And therefore it's not our fault if we are trading at a small premium. That is to do with valid reasons in China, where the markets have been disappointed and the policies have been such that they have hurt investors, and therefore investors are upset. And that is one more reason to be positive on India, that in the past we have done these numbers without having any tailwinds of people actively seeking us, at least within emerging markets. And now there is a valid case for them doing so.
So if you look ahead now, if you're a small investor watching this program and saying, what should I do right now? Should I get in or not? What would you tell them? That, look, people are saying there are going to be tailwinds. The Indian economy is doing well. If the economy is growing at 5%, 6%, 7%, then getting equity returns of 12 or 13%, going forward, may well be, it's not unusual or unrealistic.
So first thing is that if you look at past any broad period, it's in this range. Now, why this number is fair and not unreasonable to expect going forward? First is that the 6-7% GDP is in dollar terms. So that means in nominal terms, the GDP itself is growing 11-12%. And therefore, India is growing 11-12%. And therefore, corporate earnings growing 1 or 2% higher. 13-14% is not unreasonable, because the corporate sector is a little better than the overall economy. Secondly, if we look at the earnings of most of the market, which means if you look at big picture, the earnings in general for financials, for consumer, for IT, broadly it has always been as a group within a mid-teen kind of range, and then some companies grow a little more and some little less. And the third is if you look at equity risk premium, which means how much do equity markets deliver over and above the fixed income government bond of the same market.
But Samir, if I can interrupt you, there could be one other major factor this time around, which are the Indian retail investors who've often missed out on rallies in some form or the other. Even today, if you look at the amount of exposure that Indian retail investors have to the stock market, it's what, 4%, 5% or thereabouts of their total assets. It's 50% in real estate. Now that SIP money is starting to come up, and that money which is going to be coming from retail investors into the stock markets is something, are inflows that could actually keep the markets buoyant for a while.
So SIP is already at around 14,000 a month, slightly less than 2 billion a month. So that is $24 billion, the domestic guy, because there's no really net anything else. A SIP is the net flow. Rest is inflow, outflow. So you're getting about $20-odd billion a year in mutual funds.
Right, Samir. So you'll obviously make more money if you're buying the right stocks, buying the right sector. So when it comes to getting the asset allocation correct, what's your view? Large cap, small cap? Should you be buying IT, not buying IT? Where do you think people should be investing their money?
So on that, generally, like we in the past have added about 6-7% per annum over the index in the last 18 years that we've been at Helios. But the allocation, we are basically, even though we are an offshore fund, basically treating it like a flexi cap fund. And in a flexi cap fund, which is more or less representative of the market, the large caps are about, I think, 68-70%, and mid and small are 30%. So at the first level, for somebody new, this is the range. If somebody is aggressive, they may have a little bit more in mid and small. But generally, 70-30 is what the market is.
All right, Samir Arora, in a nutshell, what you seem to be saying is just sit tight, hang in there. It's going to be a long ride, so enjoy it. Thanks a lot for joining us. Let me get one more view on that from Feroze Azeez, who's now also with us. Feroze, right now, markets at an all-time high. Is there a smile on all of your clients' face?
Yes, Vikram, sir. Of course, markets are at all-time high. That generally creates positive hormones in an investor's body, so they're happy. I think having the right asset allocation has been the key. So 60-70% of long-term monies have always been in equity for our clients, so they are happy. But coming to markets, when they have reached where they have reached, if you look at the corporate earnings, have been phenomenal. And I think quite a few people, when they have an opinion on the market, they don't look at the scoreboard as intently and minutely. So if you look at the corporate earnings, 936, which is the Nifty earnings expected, if you ask me, and looking at all the top 50, all the 50 constituents of Nifty, in my belief, 936 should be overachieved this year.
So if I can just pause you for a minute to try and sort of decipher this for retail investors and others watching this, what you're essentially saying is that, yes, the markets have risen a lot, which is great, but you're also saying that corporate earnings have also risen sharply in the last 3 years, from 538 to 936, and so therefore it's not necessarily a bubble that is taking place. It is being backed by a sustained growth in earnings that we've seen in the last few years. Would that be a fair way of summarizing what you've said?
Fair and a far more clearer way, let me put it like that. And also, if you look at the P of Nifty 2 years back, when Nifties were at 14,000 post-COVID, are identical to the earnings P today. But Nifty is at 19,500. That's because the pace at which Nifty has risen, earnings have also risen the same amount. So valuation has not gone up, price has gone up, because price has some correlation to what earnings happen. And Vikram, so if I have to take it to the next variable, if you look at from the fiscal prudence standpoint, I think that's really worked for the markets.
So is that your view then, Feroze, that this sort of a growth could continue for the next 3 or 4 years? If you're having 12, 13% equity returns, 14% equity returns, then you're essentially looking at a position where the Nifty could double within 6 years or 7 years.
Yes, absolutely. In 6-7 years, Nifty can double. But what happens is, if this kind of consistent 5-year earnings growth comes, then there is generally a PE expansion. We have also looked at a forward PE in the past of 29-30. Okay, we are not at that range. Of course, it is outrageous to be at that range, and we would actually be speaking more negative at that point in time. But 20 is not something which will sustain. It will go to 22, 23 if this were to come true, because then you have both the things working for you, the earnings growth and the expansion as well.
All right, Feroze, lots of good advice from both you and Samir for people who are watching the Indian stock market closely. Thanks a lot for joining us with that. And let's now turn to our newsmaker of the week. Indian football has experienced a remarkable surge in recent times with consecutive triumphs in the Intercontinental Cup and the SAF Championship. The Indian national football team has showcased their potential by defeating formidable opponents like Lebanon and Kuwait. The Blue Tigers, as they are fondly called, have sparked renewed interest and enthusiasm among fans, igniting a passion for the sport that had been somewhat dormant for a while.